All right, Marco Palmero, founder of Ulysses in Dubai. In this video, we're going to talk about pricing for small business acquisitions. Now, before we dive into this topic, I want to ask you a question. Have you ever wondered why two companies that seem fairly similar from the outside sell for different prices? I'm sure you've seen many scenarios where this has happened. And if you are an individual, a self-employed person looking to buy a business, chances are you wondered how these two businesses were valued and how was it possible that two companies that appeared to be very, very similar ultimately got sold for different prices. So we're going to dive deeper into this concept and talk a little bit more about how companies get sold, especially small businesses, and why there's such a huge discrepancy sometimes amongst different assets. Well, first of all, allow me to say that any asset will sell for the price buyers are willing to pay for it. So the market really determines prices. But provided buyers are savvy enough and they're following best principles, there are some criteria that most people will follow when valuing a business, and therefore some expectations that sellers can have when they go to market and look to sell their particular business. Now, in order for me to explain this concept a little bit better, let me use an example, because what we're going to discuss here is valuation multiples. So when it comes to prices and final prices for a small business that gets sold, most of the times what we see is that price is a reflection of an EBITDA or seller discretionary earning multiple. What that means is that you simply take the EBITDA generated by that business over a certain period of time, you add a multiple on it, which is determined by industry standards, and then you reach the final valuation and selling price for the business. Now, let's use an example to crystallize this idea. Let's assume we're talking about two businesses that are identical. So two legal practices, for example. Both legal practices are generating $1 million in revenue every single year. However, the difference between the two is that one of them is generating $100,000 in EBITDA, the other is generating $250,000 in EBITDA. Now, since they're operating in the same industry, in the same vertical, the trading multiple for these two businesses are going to be the same. And let's just say, for the sake of this example, that multiple is 5 times EBITDA, okay? Now, the first business can expect to sell for 5 times $100,000, $500,000. The second business can expect to sell for 5 times $250,000, which is $1.25 million. So, provided all the variables are the same, the EBITDA is the biggest discriminator, okay? So, again, we took all the variables and we put them as equal. Provided all that is clear, then EBITDA is what determines the pricing of a particular business. Of course, that changes if we're talking about assets that are in different industries, in different verticals, and that's very difficult to compare because a legal practice and a medical clinic might be valued very differently. The multiples might be different because they're two separate industries. So a lot more variables get involved when valuing these businesses, and it's much more difficult to compare the two opportunities, if that makes sense. You might wonder, well, what are some of the criteria that buyers can follow to identify this trading multiple? Well, I recorded a specific video on the matter. Go check that video out if you find it helpful. But to summarize that briefly, industry, geography, profitability, the current market rate for that business, growth potential, stability, risk, all these elements are considered when coming up to a valuation multiple for a specific industry, specific business. Now, that determines pricing, the ultimate pricing. And it's a very simple thing to do, really. You just take the EBITDA or the seller discretionary earnings and you multiply it for the industry standard, and then you come up with pricing. That, of course, can drastically affect how much a business can get sold for, because in the example I just gave you, two legal practices that seemed very, very similar from the outside were selling for two very different price points. One was $500,000, the other was 1.25 million. And so it all comes down to the figures and the profitability that you generate, the EBITDA that you generate. And that is because EBITDA or cash flow is what buyers really care about when buying small businesses. Now, if you're looking at an acquisition for yourself, I would recommend, and this is just my take based on what we do at Ulysses, that you take care of looking at EBITDA very carefully. I'm sure you might be wondering, well, what happens if a business is break even or is losing money? Well, that complicates the situation because, of course, it's a lot more difficult to use an EBITDA multiple to value it. My take on that is I don't buy unprofitable or break-even businesses simply because I don't want to get involved with it. I don't like the idea of fixing a small business. If it isn't working, I'm not really the guy who's going to make it work, right? I just want to focus on something that is good, that is already performing, and make it better over time. And that is really all I care about. So I don't spend much time wondering how to value a struggling business, how to value a break-even business. I just stick to the very simple concept of finding profitable opportunities and putting a multiple of EBITDA on it. Very vanilla, very simple, and it has paid very well for us and for other people that we've worked with in UAE, Middle East, and across the world. So the point is, the valuation and the price that companies get sold for, especially small businesses, is a reflection of the EBITDA. Small business owners interested in selling a business might want to look at this video and potentially take care of fixing that aspect of their business, because I'm sure in some part of the world, people may drive profitability down to zero because they don't want to pay any taxes. They want to do some crazy shenanigans. And when they happen to go to the market to sell their business, they're going to get a very low valuation for their business simply because they drove all the expenses, sometimes even the personal ones, which is just crazy, into the business to lower profits. But then buyers will not pay a huge multiple for that business. And as a consequence, people wonder why they're unable to sell their business for what they think it's worth. And the point is, you shouldn't do crazy shenanigans. That's just my perspective. But the point is, prices and price differences in small businesses are determined by multiples of EBITDA. If EBITDA changes, which is generally the only variable if you're targeting the same industry and the same vertical, then prices are also going to change as a consequence. And what I like to do generally is to normalize and make all the other variables look the same so that I can use EBITDA as a discriminator. And what I mean by that is simple. I can focus on one vertical, one industry, one specific service, and make sure all these things are matching in all the targets that I'm looking at. When I do that, all these things I don't need to consider. I can just focus on the one variable that really matters, which is EBITDA. And that enables me to really compare opportunities in a much easier way, because I don't need to do cross-industry comparison and crazy stuff and use comparative charts and stuff like that. I really think it's pointless in small business acquisitions. I just need to pick an industry, pick a vertical, stick to all businesses that look the same, and then use the only discriminator that really matters, EBITDA. Once I got that, I can compare, opportunities accordingly and then make the decisions based on that. Hopefully you find this video helpful. If you're a professional or self-employed person or a first-time investor looking to buy a business, our company Ulysses just started supporting other businesses in buying assets in UAE and Middle East, and also online assets for that matter. So if you're interested in that, make sure you check the link below. We generally take on only a few engagements per quarter because we're mostly focused on our own acquisitions and some of our corporate clients. But provided we have slots available, we'll be happy to guide you through the process of buying your first business, your first profitable business, and then see how we can work together on multiple acquisitions, hopefully. So make sure to check the link below, and I'll see you in the next one.